Good evening again, and thank you all for joining us on another exciting webinar here at the United States Senate Federal Credit Union. We are glad that you are joining us on a topic that you know what, although it is July, um, and um, and obviously it's mid-year, but it's a very important one, and it's very helpful resources and all the information that our great marketing team along with our IRA department has put together for you all this evening. Um, uh, I think that IRAs is something that I take myself very dear, just because I have a couple of family members that actually are really invested into IRAs, just because of their own small businesses, and they don't have they don't work for a normal company that provides 401ks, or obviously also for tax purposes as well. So IRAs are really a great product to explore. And again, we're very thankful that you're joining us this evening. With that being said, let me go ahead and do an introduction of our panel for this evening. With no particular order, we do have our marketing queen, Carrie Lazar, who is joining us. Thank you, Carrie, for putting all of this together. Also from marketing, we have Eddie Villanueva, who is also going to be keeping track of our chat and our Q&A. So if you have any questions throughout the presentation, make sure that you submit them either via chat or through the Q&A function. Our commitment, like we do every Wednesday, that we answer every question that comes through the chat or the Q&A. So please, we encourage everyone to participate in the chat and Q&A function. We are excited to have one of our very own, an expert in the subject. We have this evening joining us, Mary Nelson, who is our senior IRA specialist. Actually, she is not just, that's just one of the many titles that she holds with the credit union, but this is Mary's. She has been with the credit union for 23 years, has over 30 years of experience with IRA. So thank you so much, Mary, for joining us. She will be answering your questions towards the end of the presentation. So please stay tuned. If there's anything that you need to know about IRAs, make sure that you stick to the end and submit your questions, and our very own Mary Nelson will be gladly able to answer those for you. And with that being said, it's a great segue for me to introduce Kim Freely, who actually will be leading the webinar. And as many of you know, you're obviously very familiar with Kim by now, but a fun fact, that one of the reasons why Kim is doing this presentation is actually because she has been certified on IRA. So it's you have an outstanding panel this evening. So we are very thankful that you are joining us. So with that being said, and obviously I forgot to introduce myself, but as many of you know, my name is Milton, and I'm the membership development officer here with the credit union. And let me not continue to hold the floor. I'll pass it over to you, Kim. Thank you so much.
Thank you so much, Milton, for that very nice, warm introduction. And welcome to our members. We are so honored and privileged that you are not only a member, but that you have decided to spend a portion of your evening talking about and understanding IRAs with us. And as always, I will always say, spread the word about our credit union to your friends, your family, your neighbors, your colleagues. We take a lot of pride in helping our members meet their financial goals, their financial dreams. So spread the word, and we are going to get started understanding IRAs. So I'm going to turn my camera off so that you can see the PowerPoint and get the most out of the slides. So understanding IRAs. As you can see, this is today's agenda. What is an IRA? We're going to go over IRA benefits. We're going to compare IRAs. We're going to talk about contribution limits. Distributions, retirement plan portability, we're talking about share insurance, and we have lots of planning resources for you. It's always our goal as a credit union, as your credit union, to give you the planning resources that you need to meet any of your financial goals and dreams. Hopefully, this agenda has at least one or more items on it that you were hoping to get out of this webinar and that we could clarify for you. So let's go ahead and dive. Even though I love my job, I look forward to retirement. So me putting those goals, those plans into place is so critical for me to be able to retire financially well. Technically, IRA stands for Individual Retirement Agreement, but most of the time you will hear account for the A in the acronym, Individual Retirement Account. But IRAs allow you to save money on your own for retirement. Whether you're self-employed, you just want to supplement any employer benefit package you may have. IRAs do allow you as the investor to save with tax-free growth or on tax-deferred basis. And we'll cover all of this later on in the slides. But anyone with earned income, this is good news. Anybody with earned income can open and contribute to an individual retirement account, an IRA, including those who, and this might be something that you didn't know, including those who actually have a 401k account through an employer. You can open an IRA through almost any credit union, bank, brokerage company, or investment company, but we all know that opening it up here at the United States Senate Federal Credit Union is the best place for you to have your IRA. There are two main options for IRAs, and we do offer both a traditional IRA or a Roth IRA. Mainly the key difference between these two IRA accounts is how they're taxed. Traditional IRA contributions may be tax deductible depending on your income. Those contributions are typically taxed when you withdraw the money. And then a Roth IRA, actually the contributions cannot be deducted from your annual income, but they typically are not taxed when you withdraw the funds in accordance with, of course, IRS regulations. There's also an employer-funded IRA, including simplified employment pensions, a SEP IRA and savings incentive match plan for employees who are typically employed or small business owners. The rules and annual contribution limits for a SEP IRA, and just to let you know, the credit union does offer SEPs as well, and simplified IRAs are different from traditional and Roth IRAs. Their contribution amounts are different. If you are self-employed or you happen to be a small business owner, a SEP plan is an alternative way for you to set aside money in our income tax deferred for retirement. Again, another tool to save for your retirement. We do have Fellows. We partner with Fellows Financial Group. That's one of the resources that we will discuss with you at the end of the PowerPoint that you can actually take the benefit of speaking to them if you have any questions. But aside from these fundamental differences, Roth IRAs and traditional IRAs also are also different in a few other ways, which we'll cover in just a few slides. But we always want to say that generally it's really a good idea to consult with a financial advisor, that could be Fellows, or your tax professional for personalized guidance regarding IRAs and retirement plans, because everybody's picture is different. So let's talk a little bit about IRA benefits, and there are a lot of IRA benefits. We're gonna dive into 4. So let's first talk about the tax advantage, the benefit of the tax advantage. Depending on the type of IRA you choose, an IRA can reduce your tax bill either when you make contributions or when you take withdrawals in retirement. Dividends earned are tax deferred for, of course, a traditional IRA, or tax free for a Roth IRA. Which means contributing money towards your retirement either it's going to reduce your income taxes for the year, or it's going to eliminate the taxes from your retirement money. The next IRA benefit we're going to talk about is growth. Build your account with income from interest that compounds each year without taxes nipping away at it. Really, really good benefit of an IRA. The next benefit that we're going to talk about for IRAs is the flexibility of IRAs. They're very accessible, and most people are eligible to open and contribute to an IRA. There can be a wide range of investment choices. We talked about that earlier. That includes, deposit accounts. You can open an IRA savings. You can open an IRA certificate that has a specific term. There are mutual funds out there, stocks, annuities. Again, if that's something you're interested, we can make an appointment for you with Fellows Financial Group. And then the last benefit we're going to talk about is security. So you can actually use an IRA to start saving, of course, for retirement, or to supplement and help diversify your savings that you may have in other retirement accounts. Credit union IRAs are insured by the National Credit Union Association. Of course, it's a government-run agency that provides protection if a financial institution were to fail. The NCUA does cover IRA deposits up to $50,000 per individual that are held at NCUA insured credit unions. And keep in mind that the $250,000 for IRA is completely separate from non-IRA savings accounts. The FDIC protects IRAs, of course, that are held in banks. So if you're familiar with FDIC, NCUA is the same except for credit unions. So let's talk about USFCU IRA options. We already said that we offer traditional and Roth IRAs. Either may be opened as a savings account or as a term certificate. We talked about competitive dividend rates, no setup fees or monthly annual maintenance fees. These are all benefits of being a member of a credit union. There's a low, only $5 minimum balance to open an IRA savings. So you could open it, and then each month, if you wanted to make your contribution, as long as you didn't go over the contribution amount by the end of the year. So again, we're talking about flexibility, low minimum balance, the ability to purchase a share certificate with the IRA funds. And right now, the credit union has the best rate in the nation on the 24-month certificate. So we're going to talk a little bit about making sure that you're making the most of your IRA savings so that you can competitively retire financially well. That's the whole purpose of retirement and IRAs. So we're going to talk a little bit about traditional IRAs and Roth IRAs. We're going to start with traditional. A traditional IRA, of course, offers individuals a way to save for retirement with potential tax advantages. Here are some, we're talking a little bit about the key features of a traditional. We're talking about traditional IRAs. So one of the key benefits is tax deductible contributions. Contributions made when you make a contribution into a traditional IRA may be tax deductible depending, of course, on your income, meaning they may be deducted from your taxable income from the year that you make the contribution. This can potentially lower your overall tax bill. The second key benefit we're going to talk about is tax deferred growth. So the funds within a traditional, again, we're talking about traditional IRAs, IRA grow on a tax deferred basis. Which basically means you don't have to pay taxes on the earnings of your investments. within the account until you actually withdraw them. The third key benefit is required minimum distributions, which most of us know it as the acronym RMD. Starting at age 73, you are required to begin taking minimum withdrawals from a traditional IRA. These withdrawals are subject to income tax. The fourth key benefit of a traditional IRA is penalties for early withdrawal. This is really important. If you withdraw funds from a traditional IRA before the age of 59 and a half, you could be subject to an IRS 10% early withdrawal penalty, in addition to regular income tax, unless you meet certain exceptions. Really important to know that. You might consider a traditional IRA, if you have access to an employer-sponsored retirement plan, or if you're currently in a higher tax bracket than you anticipate being in after retirement. We're going to say this throughout this entire slideshow presentation. It's recommended, we recommend you to always consult with a financial advisor, which could be fellows or a tax professional, to understand how a traditional IRA could fit into your specific financial situation and retirement goals. So now we're going to talk about Roth IRAs. The key features of Roth IRAs: tax-free qualified withdrawals. So contributions to a Roth IRA are made with after-tax money, meaning you don't get an immediate tax deduction. These contributions may be withdrawn at any time without being subject to tax or incurring an IRS penalty. Qualified withdrawals of contributions and earnings in retirement are also tax and penalty free. So this type of IRA can be beneficial if you anticipate being in a higher tax bracket during retirement. The next key benefit of a Roth IRA is there are no required minimum distributions like the traditional, so no RMD. So unlike the traditional IRA, Roth IRAs do not have required minimum distributions during the account holder's lifetime. This allows for more flexibility in managing withdrawals and potentially passing on the account to specific beneficiaries that you name. So the next key feature is contribution eligibility. There are income limits for contributing to a Roth IRA. Eligibility to contribute to a Roth IRA is going to depend on your modified adjusted gross income, your MAGI, MEGA, and these limits are regularly adjusted by the IRS for cost of living. So it's important to review the current limits and again, consult with your financial advisor for the most up-to-date information. We're going to talk about penalty-free early withdrawals on contributions for a Roth IRA. Contributions that you make to a Roth IRA can be drawn at any time without IRS taxes or penalties. However, withdrawing earnings before age 59 and a half may result in taxes and penalties unless you meet certain expectations. The Roth IRA 5-year rule says you cannot withdraw earnings tax-free until you reach, again, the magic age is 59 and a half, and it's been at least 5 years since your first contribution to a Roth IRA account. So the time is now if you don't have a Roth, and the Roth IRA is the IRA that you would benefit from. You may, most people might want to consider a Roth IRA if you expect to be in a higher tax bracket during retirement. As with any retirement account, Again, it's recommended for your specific financial situation and goals to meet with a financial advisor or tax professional to determine if a Roth IRA is the right choice for you. So that was traditional and Roth. Now we actually have an at-a-glance breakdown for you. And the good news is you are going to get this entire slideshow. Typically, it's a couple days after we present it, but you'll be able to go back and look through this and make notes. But here's an at-a-glance breakdown of the differences between traditional and Roth IRAs. And most of it we just talked about, but we'll go through it real quickly. So the yellow column is traditional, the blue column is Roth. So for contributions, traditional may be tax deductible, reducing your current taxable income. Contributions to a Roth are made after tax with no effect on your current taxable income. Distributions for a traditional in retirement are taxed as ordinary income, and qualified distributions for a Roth in retirement are not taxed. Dividends earned are tax deferred for traditional. Dividends earned may be tax exempt for a Roth. RMDs are required at age 73 for a traditional IRA. There are no RMDs required for a Roth. So hopefully that is helpful, and you'll be able to go back to this slide presentation and be able to use this at a glance breakdown. So let's talk about contribution limits. The most you can contribute to your combined traditional and Roth IRA is the lesser of contribution limits for 2023 are actually $6,500 or $7,500 if you're age 50 or older by the end of the year. So the IRS does allow you, if you're age 50, you can do a catch-up contribution if you have not been contributing enough to meet the goal of your retirement age that you have as a goal. And your taxable compensation for the year. The IRS sets these limits. The credit union does not, for the amount that an individual can invest in an IRA each year. These annual contribution limits are periodically adjusted by the IRS to account for factors, like inflation. Distributions, actually, let me go back for a minute. The most you can contribute in 2023 to all your traditional Roth IRAs, and we already talked about it, I just want to go over it again, is $6,500 or $7,500, which means you can't contribute to a traditional and a Roth. You can't contribute $6,500 or $7,500 to a traditional and contribute $6,500 or $7,500 depending on your age to a Roth. It is one or the other. So now we're going to talk about distributions. Oh, sorry. One more thing. Contribution deadline for the prior year is your tax filing due date, not including extension. So I'm going to just give you an example. You had until April 18th of 2023 to make your 2022 IRA contributions. So hopefully that is helpful as well to you. Distributions, we're going to talk about, this is withdrawals from your IRA. Age requirements, withdrawals free of IRA penalties may begin, and again, it's that magical age of 59 and a half. Roth IRAs must be held, we already talked about this, for 5 years in addition to this age requirement of 59 and a half. A required minimum distribution, RMD, must be taken from, of course, the traditional, not the Roth IRA, beginning at age 73. That did change January 1st of 2023. Tax implications. Let's talk about tax implications. Withdrawals from traditional IRAs are reported as taxable income in the year they are withdrawn. This means that distributions or withdrawals are subject to federal income tax and in some cases, state income tax as well. So we're going to go over required minimum distributions again, RMDs, and give you a little more in-depth information about the required minimum distribution. Beginning in 2023, and I kind of just went over this, the Secure 2.0 Act raised the age that you must begin taking RMDs to age, they changed it to age 73. Failing to withdraw the RMD amount or withholding less than the required minimum can result in substantial penalty. You want to make absolute sure that you take your required minimum distribution. The penalty, believe it or not, is generally 25% of the RMD amount that was not withdrawn on time. You don't ever want to let this happen. I will say this penalty can be reduced to 10% if you're really proactive. If you as the taxpayer take corrective action really early. If you catch it, you definitely want to take your required minimum distribution. The required minimum distribution for any year is the account balance as of the end of the immediately preceding calendar year divided by distribution period from the IRS Uniform Lifetime Table. We're going to give you some resources for that as well so that you could figure out your RMD if you choose to. Most of the time, your financial institution will do that for you. To calculate your RMD for this year, you would divide your account balance at the end of last year. So December 31st of 2022. By the IRS, it's not the credit union's life expectancy factor, it's the IRS life expectancy factor that corresponds to your age. You can see at the bottom of my screen, and we will put it in the chat, irs.gov, Uniform Lifetime Table, another resource that you can go in and calculate what your RMD would be. Oh, and as you can see, it's the prior year balance divided by the life expectancy factor. So let's talk about moving between IRAs and other retirement plans. So movement of IRA money. Funds can be moved. They may be moved from one IRA to another or between IRAs and other types of qualified retirement plans. There are multiple methods and rules governing this portability. So we're talking about portability. So let's talk about IRA to IRA. A trustee to trustee or direct transfer occurs when, like IRAs, are moved directly between financial entities. These transfers are popular because they are unlimited and require no tax reporting. So when we say like IRAs, we mean traditional to traditional, Roth to Roth. So let's talk about a rollover. A rollover between IRAs occurs when you actually withdraw your IRA and take it to an IRA somewhere else. And a rollover is considered you're taking the money out. So you took a withdrawal and that check is made payable to you. Rollovers between IRAs must be completed within 60 calendar days and are limited to one rollover every 365 days. So it's so important if you are just rolling it over and you have no intent on spending that money, that you take that money and invest it at the credit union within 60 days, and only one per year. Rollovers between IRAs are not subject to tax or IRS penalty, but they are reported to the IRS. So let's talk about movement between IRAs and qualified plans. So pre-tax retirement funds may be moved between traditional IRAs and other retirement plans such as, 401ks, 403b, a thrift savings plan. Roth IRAs held within employer plans may be moved to Roth IRAs, but not the reverse. While qualified plans may have their own rules regarding these transactions, these generally will fall into two categories, and you can see them on your screen. Direct rollovers move funds between financial entities. You may not take receipt of the money in the process, meaning the funds are not made payable to you. These transactions are not subject to tax or IRS penalty, but they do have to be reported to the IRS. And then you have an indirect rollover, which typically means it occurs when you take a distribution from your qualified plan and you deposit yourself into an IRA, meaning it's made payable to you. The qualified plan is required at that time to withhold 20% federal tax from your distribution, and you must complete the transaction again within that 60 calendar days. Indirect rollovers must be reported to the IRS. You'll usually face the decision of what to do with an employer retirement plan if you leave a job. But you might even have an old 401k that you've forgotten about hanging around from a previous employer, and it's never too late to examine your holdings and decide whether to roll your assets into your current employer plan or an IRA. I've been here at the credit union for almost 16 years, but prior to 2007, I did work at DuPont Community Credit Union for 12 years. And when I left DuPont Credit Union to come to the U.S. Senate, I had a 401k that I had to roll over to. I chose the U.S. Senate, of course, and I rolled them over into actual IRAs, traditional IRAs. So just a little personal story there. Again, we always want you to consult with professionals. Remember, it's so important to remember this is the IRS we are dealing with. Rules and regulations surrounding retirement funds portability can be very complex. It is essential to gather all the necessary information and seek professional advice. A financial advisor can guide you through the process, explain any tax implications, help you make informed decisions based on your specific circumstances to ensure a smooth and appropriate process. So very, very important. Go back just for a second. Okay, sorry. We're going to move on. So the next slide we're going to talk about is Retirement Central. This is something that the United States Senate Federal Credit Union has as a resource for you, our member. There's education, planning tools, online account management. You can even open your IRA in Retirement Central. It's really informed planning is one of the cornerstones of an effective retirement strategy. Don't wait till it's too late. Don't wait till it's, a couple years before you retire. The time to act is now. So visit Retirement Central from our website. We hope you enjoy this, in-depth knowledge base to help you decide what you need to do from our website. There's a wide variety of planning tools and resources covering numerous aspects of retirement planning, from selecting the best type of IRA to designing a retirement income strategy that best fits your personal objectives. Planning tools. Each planning tool includes a thorough introduction of the tool's purpose, so very user-friendly, as well as a summary of the financial information you'll need to have available when using the tool. So as you begin using your planning tools, be sure to check out the links on the right-hand side of your screen for specific recommendations on related information and tools that may also be helpful to you. One is an IRA selector tool. There's a required minimum distribution planner. There's a rollover planner. There's a conversion tool if you were to convert your IRA. There's beneficiary planners. Life stages. Explore some of the key topics you should consider at various life stages to help help ensure a successful retirement. So if you're at retirement age and you didn't start planning early enough, it's really time for us to educate and advise our children, our grandchildren, our nieces, our nephews, anyone who is important in our life, to really start this retirement process early. There's also an FAQ within Retirement Central. You'll find answers to these type of retirement planning questions: traditional versus Roth, beneficiary designation. All you have to do is click on these topics, and there's a whole FAQ built for you. Transfers and rollovers between IRAs, divorce situations, distributions prior to age 59 and a half. Remember that magical age. Distribution options for IRA beneficiaries, required minimum distributions, RMDs, and contributions and deductions. So just a wealth of information out there for you as our member. We are dedicated to give you the resources and the information that you need in order to retire well. We always want to let you know that your money is safe and secure here at the credit union. We already talked about this. You are insured through NCUA for up to $250,000. This is separate from your non-IRA shares that you have. And we can confidently say that when you save at a federally insured credit union like ours, you are safe and sound, because not one single member has ever lost a cent from accounts insured by the NCUA. We have been in business since 1935. We are a very sound and secure credit union. So you can trust your savings, whether it's IRA or non-IRA, here in our credit union. There's a share insurance estimator. You can check your coverage at mycreditunion.gov. Great resource for you to be able to make sure that you are fully insured. The National Credit Union Administration, or NCUA, it is an independent agency that administers the insurance, like, and we've talked about this before, like the FDIC's deposit insurance for banks. The National Credit Union Share Insurance Fund was created by Congress in 1970 to insure members' deposits in federally insured credit unions. Each credit union member, like we said before, has at least $250,000 in total coverage, and your IRA and your non-IRA are insured separately. So credit union members can use the share insurance estimator from mycreditunion.gov to calculate what portion of their accounts are insured. Again, we want to go over the resources that we have diligently put together for you as our member. Retirement Central, we just talked about. That's where you have calculators, estimators, articles, and other retirement planning tools. Share that with your friends, your colleagues, your family, your friends. Our website is open to anyone. Advisory, USS FCU Advisory Services. We already talked about how we partner with Fellows Financial Group to bring members access to professional financial planning and advisory services. So if you have retirement planning questions that we can't answer, we are happy to connect you with a Fellows advisor. We can do it by phone, email, we can schedule a one-on-one if you're in our area, or I'm sure they would be open to a Zoom or some other type of video meeting. IRS.gov is another great resource. They have worksheets and other resources that can help determine the payout periods and the amount of your required distributions. And the Social Security Administration, check your eligibility for benefits. Calculate what you can expect as your Social Security retirement benefit. I say that I learn something new every time I attend or present in one of these webinars. And I've been in the credit union industry since 1996. And I learned something new every single time. I did not know about the Social Security Administration information. It used to be that you would get this letter in the mail and they would tell you what your estimated Social Security would be when you retire. You don't get that anymore, at least I don't. So I can't wait to go to this website to try and determine what my Social Security retirement benefits will be. And that will help me to know what IRAs I need to open, and so forth, so that I can also retire financially well. The Employee Benefits Security Administration, EBSA, they provide a web page dedicated to consumer information on retirement plans to provide retirement plan participants and their beneficiaries with information on their rights under federal law with respect to their plans. The information ranges from very basic general information about the law to actually numerous specific issues. Another resource is the Department of Labor and Investor websites. They also have retirement planning information. So lots and lots of resources to help you figure out what is best for your retirement future. There is an important disclosure at the very end, and APY's annual percentage yield. The content, we always like to say the content in this presentation is for informal purposes only and is not to be considered advice or recommendation of any specific investment product or strategy. We just want to give you the resources that allow you to make the decisions that are best for your financial goals and your financial future. So before acting, and I think we've said this on every slide, and we just can't say it enough, before acting on any information in the content of this article, please seek professional, personalized advice of legal, tax, or investment professionals. I do really hope that this webinar has been beneficial for you, that we have answered some of your questions. I hope you put questions in the chat or in the Q&A. We are ready and wanting to answer those for you. And remember, the credit union offers IRA products and services to meet your financial needs and goals. You don't have to go anywhere else. My name, again, is Kimberly Fridley. I'm the Membership Development Analyst. Hopefully, Carrie or Eddie will put my email. I don't even mind if they put my direct phone number. I would love to talk to you about IRAs and helping you to open direct transfer any IRA that you need to into our credit union. So I am now going to turn it back over to the marketing team so that Mary, our IRA expert, can answer any questions that you may have had during this webinar. And again, we value your membership. Thank you for attending. Please stay while we answer the questions.
Kim, you did an excellent job. Thank you. Thank you very much for going through all that important content. Like you were saying, you've been in the credit union industry, or the financial field, I should say, since 1996. And you're still learning new things. So I definitely second that. Every time we do these presentations, I learn something new. And I'm excited. You know, Mary's always giving me a hard time because he's like, Eddie, have you opened an IRA? It's never too early to open an IRA. So now this confirms that I definitely need to open an IRA and look at my options. But once again, thank you very much. I know that we have some great questions. So I don't know if Carrie or Milton, one of you would like to start, or I can start, whichever you would like. But we have some great questions that I know Mary knows the answers. She's better than Wikipedia, to be honest with you, everybody. Mary has that experience, and she lives IRA, she breathes IRA. She's very knowledgeable. So Milton, do you want to read a question, or Carrie?
absolutely, Eddie. Thank you so much again, and Kim, a wonderful job again. Like always, truly appreciate it. With that being said, thank you all so much for submitting your questions. Like Eddie alluded to, we do have multiple questions, and we're really excited, looking forward to answer those for you, as it is our commitment for in every webinar that we do on Wednesdays. So with that being said, I have a quick question here. The first one, I'll kick it off. Either for obviously Mary or Kim, it says I have a USG TSP plan, so obviously a retirement plan through the government, and I'm already retired. Actually, you know what? I'm sorry. Let me take that back. I'm sorry. I picked on one that was already answered. My apologies about that. The question I want to read is, if I transfer my 401k to an IRA account, will I be free to set up a distribution schedule from the new IRA account?
Hi, this is Mary, and I can answer that question.
Mary.
Yes, you can set up a distribution schedule from your IRA. Our IRAs, as Kim informed you, are savings accounts and certificates. Certificates are a little more limited in being able to withdraw from because they have a maturity date. But if you need to have a liquid account, the IRA savings account functions that way. And you can set up a regular schedule of distributions that include any tax withholding you want. You can receive the payment by check, or you can receive it directly into your account here at USSFCU. So you can start taking those distributions from a traditional IRA at age 59 and a half without any IRS penalty. At 73, we talked about required minimum distributions. You can set up a schedule for those as well. And with the individuals who have reached the required minimum distribution age, we do waive the penalty for those RMD withdrawals from certificates.
As you know, USSFCU is always about returning, fees and things like that to our members. So that's a perfect example. We're waiving fees over here, guys. So sorry, Milton, I'm going to interrupt you.
No, absolutely. I just want to say thanks to Mary for answering that question and providing us with all of those details. Carrie, do you want to read the next question?
You're mute, Carrie. I don't think we can hear you. So I read the question for her. What she was trying to say is, can I transfer a traditional RIA that will mature in early 2024 to my TSP, even though I'm required to take my first RMD in 2024 when I turn 73? Thank you.
Okay, so the answer to that is that movement from a traditional IRA into a TSP is moving from an IRA to a qualified plan. And you are not allowed to roll over RMDs to a qualified plan. So you would have to take your RMD out of your traditional IRA prior to moving those funds.
Perfect. Thank you very much, Mary. We appreciate you for answering that loud and clear.
Thank you. The next question that we have here in the Q&A is, what is the difference between the TSP plan and the USSFCU IRA plan? More investment options?
A TSP plan is offered to government employees. I believe they have a selection of different types of investments with TSP. It's a qualified plan, and qualified plans follow their own rules, and the TSP plan has very specific rules. To get more information with regard to the TSP and what it has to offer, I recommend going to tsp.gov. They have a very good website to provide information. TSPs can hold both pre-tax and Roth money, and IRAs are, separated. The traditional money and the Roth money are separated. There are all kinds of investments opportunities for IRAs at various places that we talked about in the presentation. at banks, at brokerages, at insurance companies, have annuities. But at the credit union, our investments here at USSFCU are IRA certificates of deposit and IRA savings accounts.
Awesome. Thank you. Thank you, Mary. And again, we are getting multiple questions here. We have another very important question here that is coming through the chat, and it reads: I have an IRA, and I died, and I leave it to my spouse or my adult child or my 6-year-old grandchild. What happens if they want access to the money?
That's a rather in-depth question that I'm not going to be able to answer completely in this situation, although I'd be happy if you want to contact me to talk to you about it further. In general, IRAs left to a spouse, the spouse has more options than a non-spouse beneficiary. And most people do choose for that reason to leave the funds to their spouse. And then if a spouse no longer has a living spouse, then generally they leave the funds to their children or their grandchildren. So there are very specific rules from the IRS that have recently updated with Secure Act 2.0 that basically require, in most cases, the funds to be distributed within 10 years. But again, there are different options, especially for spouse beneficiaries, to take the funds as their own. To take a lump sum distribution is usually always possible. Again, when these funds are received, especially traditional pre-tax funds, they are subject to tax. So a beneficiary will want to be well informed about what they're doing and how it will impact their overall tax picture. You can name your adult children. You can name grandchildren. If you name minors, an adult will need to help them if funds need to be distributed. They'll have to sign for them, etc. So there are a lot of ins and outs to beneficiary options. And if anyone wants to contact me, they can reach me at maryn@ussfcu.org, and I can try to follow up with you more specifically.
Thank you so much, Mary, for that also. Another question here, Kim, I'm not sure if you want to take this one. And that the question reads, can I roll over a TSP into a USSFCU IRA?
So I may revert to Mary. I believe the answer to this question is yes. But Mary, can you back me up?
Yes, I can back you up. And
Thank you.
Can you repeat the question, please, Milton?
Absolutely, Mary. The question is if they're just asking whether or not they can roll their TSP plan into an IRA here at the credit union.
Okay, so your TSP, if it holds pre-tax money, can be rolled to a traditional IRA. If you have a Roth within your TSP, you would want to roll that to a Roth. If you're thinking of moving pre-tax money into a Roth IRA here at the credit union, that's considered a conversion. It will be a taxable event, and so you would want to consider that carefully, depending on the amount that you're talking about, because you would have to pay taxes in the year in which you made the transaction.
Great. Thank you so much for answering
Thank
that.
you.
And yeah, both of you, appreciate it. One other question here, and again, thank you all so much. We're getting a lot of questions that are coming through the chat and the Q&A. The next question reads, if you are retired and did not receive any income regarding work for the tax year, are you allowed to contribute money into your Roth IRA?
I'm not sure if I understood that, but basically to contribute money to a Roth IRA, you do have to have earned income. So if you, did not receive income, you cannot contribute to a Roth. The second aspect of a Roth is that you need to be eligible. So there are income limits beyond which you cannot contribute to a Roth IRA. So that's the second thing, but you definitely have to have earned income in order to contribute to an IRA.
Thank you so much for that. And one more question here, and I think that probably might be coming into the end of the questions, and that is, can you share more information with the IRAs and the share certificate accounts or CD accounts? What are the options? Does a member have to select a particular term, or can they go in and then choose any particular term that has the best interest rate, and how would it work, especially with the annual contributions that they have to make into their plans?
Okay, so we offer traditional and Roth savings accounts and traditional and IRA CDs. The CDs range from 3 months to as long as 60 months. The rates are tiered by dollar amount. So we have a break off, I believe, from $1 up to $99,999. Another tier from 100 to 200, and then 200 and above. On our website, when you check our rates page, you will see that there are different interest rates, APYs, depending on the length of the CD term and also on the amount of money that you're investing. So with contribution limits, obviously, if you're restricted to 6,500 or 7,500, depending on your age, that's the most you would be able to put in a CD or an IRA savings for each year. And if you want to contribute in subsequent years, you can, open additional CDs, or you can use a savings account if you prefer. There's nothing that says everything has to be in one place. You can, especially if you think are going to need to make use of any of the money, put some of the money in an IRA savings account that is more liquid and funds that you are willing to tie up for a longer period of time could be put in a certificate. So if you were making, say, a $7,000 deposit, you could put $3,000 in IRA savings and $4,000 in a CD, because a CD is only $1,000 minimum. So funds can be split also between CD terms. Some people like to ladder their CDs so that they come due at different times, depending on their need to possibly use the funds, or if they want to have flexibility to move them elsewhere, or if rates change, still have some room to divest.
Awesome. Thank you so much for that answer. And again, we're still getting more questions here. So Mary,
Great.
Kim, hopefully you guys don't mind. Another question, and that's kind of like in line with what you were just saying a few seconds ago. But the question reads, is there a minimum required distribution that you have to take at age 73 on a traditional IRA?
Yes, you definitely have to start taking required minimum distributions at age 73. The distribution, as Kim explained earlier, each year will be different because it's based on the ending balance of the prior year, and it's divided by a divisor found on the Uniform Lifetime Table, which the IRS puts out. And it's a divisor that continues to go down each year. So that changes each year. So with the balance and the divisor each changing each year, the amount of your required minimum distribution will also change. It's important to take your required minimum distributions from your traditional IRA because they are penalized. You are penalized by the IRS if you do not take them. The penalty is 25% of the amount you should have taken but did not. And we do waive the penalty on our IRA CDs for our members who are at RMD age so that they can take this required minimum distribution without any investment penalty or penalty for early withdrawal before maturity from the CD at the credit union.
Thank you, Mary. And I believe we're down to the last two questions. And again, we want to thank you all for submitting your questions. It's definitely a lot of great questions coming through. And Mary, thank you so much for giving us those expert answers. So the next question says, I'm 55. with a healthy TSP account, can I stop allotment contribution to the TSP and open a United States Senate FCU IRA, a Roth IRA?
Okay, I'm not sure if you're talking about moving funds from the TSP to the IRA or opening an IRA separately, but there's nothing to stop you from having an IRA if you have a TSP plan. So yes, you could certainly open an IRA. If you are talking about moving funds from TSP to an IRA, that's generally something that you can do. Again, TSP dictates how you do that and how frequently you can do that and what ways they will assist you with that. So that's at the plans rules, basically.
Yeah, I guess
Distributions.
I was going to say, Mary, I'm sorry, but I'm sorry I'm jumping in, but I guess my understanding was on that question was more of if I already have a TSP, can I stop contributing to that TSP and then start the contribution over to an IRA here at the credit union instead of continuing the contributions to the existing TSP?
You could do that. It might not be your best choice. You would want financial advice on whether that would be the best choice to stop a TSP contribution. But if you have funds to do both, obviously that's, the discretionary funds to do both, that would be great. But yes, you certainly, I believe, could stop your TSP contribution and begin contributions to an IRA. You may want to confirm with TSP whether they require certain activity to keep the fund open, but I think that's unlikely.
Thank you so much. The next question is the Roth IRA the same as a traditional IRA where you can open the account with just $5 and then continue to put money in it until reaching the yearly maximum?
Yes, both our traditional and our Roth savings accounts start with a $5 minimum and can be contributed to as regularly as say for a transfer from your checking account or your savings account, or just intermittently when you have discretionary funds available to do that. They are both the same in terms of their dollar limit, and you just need $5 to keep those open. So yes, we have both a Roth and a traditional savings account.
Awesome. Thank you so much for that, Mary. And then the last two questions. It reads, can you open a traditional IRA in the year that you're required to take your first RMD from another institution?
Could you repeat that one more time?
It says, can you open a traditional IRA in the year that you're required to take your first RMD from another institution? So I'm guessing that this person's already at the RMD age and they have an IRA with another institution. And the question is, are they able to open another traditional IRA during that same tax year?
Okay, so it sounds like they're asking whether they can make a contribution to a traditional IRA in the same year that they start taking required minimum distributions from another plan. It used to be that once you had reached required minimum distribution age, you could no longer contribute to your traditional IRA, but that has changed. And if you are still working, you can still make a contribution. But again, you have to have earned income in order to make that contribution.
Thank you so much, Mary. And the last question, and I promise this will be it. And I guess this one will send it over to Kim. Kim, the last question reads, is it better to have one big IRA or several mini IRAs? What would you advise, Kim?
So really, honestly, that question is going to be dependent on your preference. So just keep in mind that the larger the balance, your dividend rate could be higher and you could earn more dividends on a larger balance. But there is no rule stating that you can't ladder them, that, just like a non-IRA CD, you can ladder IRA CDs. You can, it's as little as $1,000 to open an IRA CD. So really, if you want to talk more about strategies, feel free to reach out to me. I'm more than happy to do some calculations, figure out what your dividends would be and what would be, the best for the money that you have in your retirement.
Awesome. Thank you so much, Kim. And also thank you, Mary. We truly, truly appreciate you coming on board and joining us on this very informative webinar. I know IRA can be a very, very tricky, especially because the tax laws are always changing, and you always have to make sure that you're staying on top, especially for those that are already at the RMD stage, that you need to make sure that you are doing that. And again, it truly is a very, very important subject to be informed, and I truly appreciate you, Mary and Kim, for putting during this presentation, and obviously Mary for coming in and providing your expertise and answering all those great questions that we've received this evening. So thank you all so much, and as always, Eddie, Carrie, thank you all for coming on board and making this possible. We truly, truly appreciate everyone joining us this evening. And with that, I also want to extend an invitation for our webinar next Wednesday. In this one, it's all about, it is summertime, and I know a lot of people are already, if you haven't planned your vacation, I'm sure you probably and already and thinking about where you're gonna go, take your family or yourself during the summertime, and then with that, during this time, there's a lot of scams that happen during the summer travel plans. So we are going to be doing a webinar exclusively on what are the scams that we are seeing here at the credit union, and how you can avoid and prevent yourself from becoming a victim of a summer travel scam. So again, we look forward to having you back next Wednesday on another exciting webinar. With that being said, thank you all to all of our panel for being present, and we look forward to have you back on another webinar next week. You all have a great evening. Thank you.
Hey, I'm sorry. Can you hear me?
Yes, we can hear you now, Kim. Carrie.
Okay. We do have one last question, if you don't mind staying, Mary, really quick. Is there a IRA tax percentage on the 25% of our RMD of your traditional IRA after distribution? And let me know if I need to read that again. I know I'm jumbled it a bit.
Yes, please read that again, Carrie. A little slower, please.
Okay. I was sorry. I was like, I got to get it in before everybody leaves. Okay. Is there an IRA tax percentage on the 25% of your RMD of a traditional IRA after distribution?
I'm not sure I'm understanding the question exactly, but let me just say that your required minimum distribution that you have to take from your traditional IRA has to be reported as income. And so it's taxed at whatever rate your income is taxed at. So that would be the percentage you would be paying on it. There isn't any special percentage or rate of tax just simply because it's an IRA distribution. It just becomes part of your income.
So
I hope that answered the question.
If I could extend on this a little bit, you may be referring to the slide that talked about if you did not take your RMD on time,
yes, the 25%
penalty.
Yeah, there is a penalty for not taking your required minimum distribution of 25% of the amount that you should have taken. So not only would you be taxed on, withdrawing the amount, which you ultimately would need to do, but you could potentially have a 25% penalty on that RMD amount if you did not take it timely. If you realize you didn't take a required minimum distribution timely, you should act as quickly as possible. And sometimes that penalty can then be reduced to 10%.
She did confirm that she understands. So
okay, great.
Good. All right. Well, thank you, everybody.
Have a good night, everybody.
Thank you so much.
For
All right. Bye-bye.